So, you've heard that getting a mortgage loan is like climbing Mount Everest, right? Think again. Let's begin by shattering some of the most common myths about mortgage loans. First off, many people believe that you need a perfect credit score to get a mortgage. That's just not true. While a higher credit score can certainly help you secure better interest rates, it's not the be-all and end-all. There are numerous programs out there designed to help those with less than perfect credit scores secure a mortgage loan. So if your score is not in that golden 700+ range, don't fret. You still have options. Next, let's talk about down payments. The old adage that you need to put down 20% of the home's value is outdated. In fact, there are several types of mortgage loans that require much less. Some even allow for as low as 3% down or no down payment at all. Of course, the amount you put down can affect your monthly payments and interest, but the idea that you need a huge chunk of change up front shouldn't deter you from exploring your options. Lastly, there's a widespread belief that mortgage loans are overly complicated and inaccessible. Sure, there's a bit of jargon to learn and some paperwork to fill out, but it's not as daunting as it may seem. There are plenty of resources available to help you understand the process. And remember, you're not doing this alone. Loan officers, real estate agents, and financial advisors are all there to guide you through the process. So, let's dispel these myths right here, right now. Getting a mortgage loan doesn't require a perfect credit score. It doesn't necessarily require a 20% down payment, and it's not an insurmountable task. Now that we've cleared the air, let's dive into what a mortgage loan really is. A mortgage loan might seem like a financial jargon, but in reality, it's quite simple. Like a key that unlocks the door to your dream home, a mortgage loan is a financial tool that enables you to purchase real estate. It's like buying a ticket to a concert, only the concert is your dream home, and the ticket is paid off over a number of years. So let's break it down. A mortgage loan is essentially a long-term loan that you borrow from a lender, such as a bank or a mortgage company, to purchase a house or property. The key here is long-term. Unlike other loans, a mortgage loan is typically paid back over a lengthy period, often ranging from 15 to 30 years. However, the unique aspect of a mortgage loan is that the property you're buying with the loan serves as collateral. In this case, collateral means that it's a sort of insurance for the lender. If, for any reason, you're unable to make your mortgage payments, the lender has the right to take possession of your property, a process known as foreclosure. Now, don't let that scare you. It simply means that it's crucial to make your mortgage payments on time and in full. Think of it as a monthly subscription to your dream home. As long as you keep up with your payments, the house is yours to enjoy. Another important thing to note is the interest rate. This is a percentage of the loan that you pay in addition to your principal loan amount. It's a fee that the lender charges for the privilege of borrowing their money. The interest rate can be either fixed, meaning it stays the same over the life of the loan, or variable, meaning it can change over time. So, in essence, a mortgage loan is a long-term commitment that enables you to own a house or property, with the property itself serving as a safety net for the lender. So, now that you know what a mortgage loan is, you might be wondering, how does it work? Just like a car, a mortgage loan has its own engine, gears, and moving parts. Think of a mortgage loan as a vehicle that can take you to your dream home. It's a complex machine, but let's deconstruct it for a clearer understanding. At its core, a mortgage loan is made up of 4 main components: the principal, interest, taxes, and insurance. Each of these parts plays a unique role in driving your loan, influencing both your monthly payment and the overall amount you owe. First up is the principal. This is the initial amount you borrow to purchase your home. If you buy a house for $200,000 and put down a 20% down payment, your principal would be $160,000. Next is the interest. This is the cost of borrowing money, expressed as a percentage of your loan. If your interest rate is 3%, you'll pay 3% of your principal each year as part of your mortgage payment. Then come the taxes. These are property taxes, levied by your local government based on the assessed value of your home. They're usually collected as part of your mortgage payment and held in an escrow account until they're due. Lastly, we have insurance. There are 2 types: homeowner's insurance, which protects your property against damage or loss, and mortgage insurance, which protects the lender if you're unable to make your payments. Now, how do these components affect your monthly payment and total loan amount? Well, each part has a role to play. Your monthly payment is the sum of your principal, interest, taxes, and insurance. divided by the number of months in your loan term. The total loan amount, on the other hand, is this monthly payment multiplied by the number of months in the loan term. Navigating this machine can seem daunting, but with a clear understanding of its parts, you can steer your mortgage loan confidently towards your dream home. Understanding these components is key to navigating your mortgage loan. But what about the types of mortgage loans? Not all mortgage loans are created equal. Different types suit different needs. So let's delve into the various types of mortgage loans out there, each with its unique features and benefits. First up is the fixed-rate mortgage. As the name suggests, this loan has an interest rate that remains the same throughout the entire term. So, if you're the kind of person who likes stability and predictability, this one might be your best bet. With a fixed-rate mortgage, you'll always know exactly what your payment will be, making budgeting a breeze. Next, we have the adjustable rate mortgage. Unlike its fixed-rate counterpart, the interest rate on this loan can change over time based on market conditions. This means your monthly payment could go up or down. If you're a risk taker or planning to move in a few years, an adjustable rate mortgage might be the way to go. Then there's the FHA loan, backed by the Federal Housing Administration. These loans are designed for low to moderate income borrowers who may not be able to make a large down payment. If you're a first-time homebuyer, you might want to consider an FHA loan. Last but not least, we have the VA loan. This type of mortgage is guaranteed by the Veterans Administration and is exclusive to veterans, active duty military personnel, and their families. VA loans often come with lower interest rates and don't require a down payment. So, if you've served our country, a VA loan could be a great option. Each of these mortgage types has its own pros and cons, and what works best for you will depend on your individual circumstances. It's always a good idea to talk with a mortgage professional to get a better understanding of what each option entails and how it aligns with your financial goals. Choosing the right type of mortgage loan can make a world of difference. But how does one qualify for a mortgage loan? Well, that's a topic for another scene, so stay tuned. Qualifying for a mortgage loan isn't as daunting as it seems. Here's what lenders look for. When it comes to lending money, lenders need to be assured that they'll get their money back. That's why they evaluate potential borrowers based on a set of criteria. Let's break these down. Firstly, your credit score. Think of it as your financial report card. It's a 3-digit number that banks use to determine how reliable you are in paying back debts. A higher score may open doors to better loan terms. Next up, your income. This one's straightforward. Lenders want to make sure you have a steady income to repay the loan. They'll ask for proof such as pay stubs or tax returns. Then, we have the debt-to-income ratio, or DTI. This is a percentage that shows how much of your monthly income goes toward paying debts. Lenders typically prefer a DTI of 43% or lower. It shows them that you have enough income left after paying your debts to cover your mortgage. Lastly, your down payment. This is the initial payment you make when buying a home. Traditionally, lenders have preferred a down payment of 20% of the home's price. But don't stress if you can't reach that figure. There are loan programs that accept lower down payments. Now, while these factors are important, remember, they aren't the be-all and end-all. Lenders look at the whole picture. So if your credit score isn't perfect, but you have a low DTI and a good income, you could still qualify for a loan. Similarly, a higher down payment could offset a lower credit score. Understanding these factors can help you better prepare when applying for a mortgage loan. It's all about showing lenders that you're a safe bet. And there you have it, a simplified guide to understanding mortgage loans. Remember, knowledge is power when it comes to home buying.